I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
Just drive, baby.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, folks, just about 11 minutes to go until we get to the final trading day and the final closing bell for the first full trading week of 2020. Let's get to our Drive to the Close guest. Jeff Krumpelman is back with us, Chief Investment Strategist and Head of Equities at Mariner Wealth Advisors, based in Cincinnati, joining us on the phone from there. Jeff, first of all, Happy New Year. Nice to have you here with Tim and myself. How are you?
Doing well. Happy New Year to you as well. I hope things are going well in the new year in New York.
Yeah, fingers crossed. It's already been, safe to say, a tumultuous week, as you well know. How do you, Jeff, we turned the calendar page, but a lot of the old problems are still with us, right? COVID, of course, and trying to get the vaccine out. And we're all just kind of keeping our fingers crossed that we get to some kind of normalcy at some point in 2021. How do you see it? And how does it ultimately, impact companies, the economy, and ultimately the financial markets? Because we continue to see this disconnect where there's some pretty terrible headlines, and yet markets have often rallied.
Yeah, there is a disconnect between the headlines and the market, and yet there's not that much of a disconnect between the economy and the market. The economy has continued to recover, and I think that it's the earnings and credit spreads and interest rates that are the things that we really monitor and that drive the market. And from a human nature, or just a human standpoint, you would have hoped that the news would be about vaccine introduction and onward and upward here, as opposed to seeing the Capitol and some of the things that just happened the other day that were absolutely shocking. And so there's depression from a human standpoint from that. But with regard to the economy, as we've seen it many times before, and we certainly saw it going back into March of last year, headlines about pandemics and COVID spread, and yet we are up 18% roughly in 2020, and who would have thunk that? And it was because, the market's forward-looking and it's all recovery, and that is actually why we maintained that hold-your-ground view, and we maintained our stock price target levels for the S&P 500 when many were taking it down, because we look at the data. Well, and that's what drives us.
Well, speaking of that data, we did see the job recovery falter today as the virus surge just snapped the hiring streak. How did your opinion change, Jeff, about the recovery when you saw that news this morning of the jobs report from December?
Well, actually, it's kind of mixed information. You had, numbers that were revised up for the prior 2 months, and they pretty much offset the disappointment for this month. But our expectations are really for a soft Q1 anyway. We're in the midst of kind of a soft patch in here where the vaccine has not been distributed in mass scale. There was a little hesitancy to know what would happen with fiscal stimulus and would that come about. And while CEO confidence has been improving, we expected a bit of a softer patch here in Q1 before you do get kind of continued and accelerating improvement throughout the remainder of the year. And at the end of the day, because of some pretty other solid economic numbers are expected to be up 20% over this next year, and I do think that we'll deliver there or close to it. You're going to see a pretty nice, I think, year for the market. Not dazzling returns, not stellar returns, but to see high single-digit returns, including dividend. That's kind of what we're looking at.
Hey, so Jeff, Jeff, where would you be putting money? Because I know our audience loves to hear specifics, and I was looking at some of the stocks
Sure.
that you shared with us. Starbucks, Target specifically are some of the names that are up on your list. Talk to us about kind of your investment thesis and where you would specifically put money right now.
Yeah, I think positioning is really key in here, and we felt good about it last year. Many people are saying, "Hey, run to value, run to the cyclicals," and they're making more heroic, extreme kind of recommendations on where you should go. And we just don't think that that's probably the thing to do. We still think a blend of growth and value. So we have a bit of what people would call a barbell strategy. We're maintaining our growth positions, and examples of stocks that we see in that growth camp. It's not just FANG. We have exposure to the FANGs. We reduced them a little bit after some success there, and it's stocks like 2-6, which makes silicon carbide that is used in making the wafers and the chips that require greater and greater just really speed and efficiency for power management and so on and so forth. Names like Micron Technology, which makes memory chips used as the cloud is built out and we move to more and more data center and cloud-oriented applications. We like also within technology, Viva is the name of the company. It's a healthcare software company that just dominates the CRM component within healthcare and software that's used to manage all these trials that are going on for the vaccines and drug development and so on and so forth.
Right.
And we find when the cyclical camp, too, by the same token, we like names such as L3 within the defense area, Federal Express, and so we think that you ought to really have balance between those two right now.
Yeah. So.
Yeah, Alibaba's on this list too. Why Alibaba?
And just got about 30 seconds.
30 seconds, I'll try and make it quick. Alibaba is just really, hey, sometimes things get cheap and they get too cheap. And, this might not be for the meek and timid, if you will, at this point in time, but it's trading at less than 19 times earnings when the S&P 500 is trading at 22 times. It has expected growth rate of 23 times. And we just don't think with the Chinese government, yes, they're playing a little tough and would like to quiet Jack Ma down just a little bit, but they also want to court and see Western investors really continue to invest over there. And so we think that this is a good entry point.
Stock's down about 25% since its October high, so we've definitely seen it pull off its best levels of the last 6 months or so. Jeff, thank you so much. Really appreciate it. Jeff Krumpelman, Chief Investment Strategist, Head of Equities at Mariner Wealth Advisors, on the phone in Cincinnati.